Picture this. You've just made your first investment. Excited about building wealth and securing your financial future. But wait. Before you dive headfirst into the world of investing, there are some common mistakes that you need to avoid. Luckily for you, we've got the top 10 beginner investing blunders right here. So you can sidestep these financial landmines and make your money work for you. Let's get started. 1. Not having a clear investment plan. A clear investment plan is crucial. Without one, it would be like going on a road trip without a map. Knowing where you are headed can help you make more informed decisions and have the discipline to stay focused on your goals, even in the face of market fluctuations. So, if the market were to enter a bear market tomorrow, would you panic and sell, do nothing, or buy more stock? Having a clear focus on your financial objectives is critical. Things such as, whether are you saving for retirement, saving for a down payment on a house, or something else. Knowing this objective can help greatly in making the right decisions at the time. Further, being honest with yourself about whether you are better suited to buying individual stocks or a passive index fund. This may help with any temptation to buy stocks recommended by a friend, YouTuber, or a fund manager on TV. Define your financial goals, risk tolerance, and time horizon, then build a tailored investment strategy. Remember, failing to plan is planning to fail. 2. Buying in a heated market. What you'll find along your investing journey is that when stocks are in a bear market, virtually nobody will be talking about them. Conversely, when stocks are in the heat of a bull market, everybody is talking about how much money they are making. There's a saying that when taxi drivers are giving you stock tips, it's time to start selling. So don't make the mistake of simply investing because the market's going up and everyone is bragging. If you want to make a lot of money over the long run, ideally you want the market to be depressed early on in your investing career. Lower entry prices make a huge difference in the long run. If the market is booming and you want to make investments, be cautious, do your research, and try not to use excessive borrowed funds. 3. Investing in what you don't understand. The single most important concept in investing is to know what you own. Stick to industries and companies you understand, and never invest in something just because it's trendy or everyone else is doing it. Paraphrasing Peter Lynch, if you can't explain to a 10-year-old in 2 minutes or less why you own a stock, then you probably shouldn't own it. Instead of buying stocks in businesses you don't understand or are the latest trend, you should stick with companies that are within your circle of competence and simple to understand. If the investment seems too complex, it's probably not for you. 4. Falling for get-rich-quick schemes. Patience is a virtue when it comes to investing. In reality, only a select few can make any real money over the long run by day trading stocks, options, or currencies. Most traders tend not to make money from the trading itself, but rather from selling software or educational programs, teaching others how to trade. The students that buy these products will inevitably lose money trading. Avoid the temptation of high-risk, high-reward schemes. Instead, focus on long-term strategies and let the magic of compounded returns work in your favor. Commit to being in the market for 10 years or more, and you'll have much better returns, much less stress, and much more time to work on your career or improving your life skills. 5. Ignoring fees and taxes. Even small fees can eat away at your returns over time. When buying or selling individual stocks, you will require a broker or a platform to execute trades. Platforms with very low trading fees usually come with little to no additional services to assist in choosing the stocks or managing taxes. Whereas full-service brokers or platforms come with more tools, but also with higher fees. If you are trading often, then these brokerage fees can really add up and eat into your profits. Holding stocks for the long run generally comes with a more favorable tax treatment. Gains on your positions aren't taxed until they are sold or realized. Frequent trading can create a continuing realization of capital gains taxes. Pay attention to expense ratios, trading fees, and taxes when making investment decisions. Keep your costs low and your profits high. 6. Emotional decision making. Fear and greed can cloud your judgment, leading to impulsive moves. This can also lead to a psychological trait called confirmation bias, which is where you seek out only that information that supports your view, and rejecting information that does not. As a human, you can't avoid being susceptible to confirmation bias. As investors, we need to recognize it and take steps to minimize its impact on our investing decisions. You do this by purposefully seeking alternative views, and only invest if you can logically dismiss those arguments with empirical data. Stay disciplined, stick to your plan, and avoid making decisions based on emotions. 7. Not rebalancing your portfolio. As you create a portfolio of stocks, you may have started with a plan of investing your available funds equally in 20 stocks. In order to create a diversified portfolio, with each holding around 5% of the total. However, over time, some stock prices will increase and others will decline. This is okay if these price movements are minimal, but often, you'll find some stocks will substantially increase or decrease, leaving your portfolio unbalanced. Set a time period of say every 3 months to regularly review your portfolio weightings and make the necessary adjustments to maintain the right asset mix for your individual circumstances. Rebalancing ensures your investments align with your risk tolerance and goals. 8. Buying businesses without a competitive advantage. Buying businesses that do not have a competitive advantage is tantamount to gambling, in that you are merely speculating that someone pays you a higher price later on. When a business has a sustainable competitive advantage, it can fend off competition over the long run, reducing the risk of permanent loss of capital. This is because customers keep coming back to their products time after time. For example, Apple has built an ecosystem that makes it very difficult for consumers to switch to a competing product. Facebook has created a network effect whereby everybody is using Facebook because everybody else is using it. There is a reason why consumers will literally cross the street to buy Coca-Cola over a competing product. If you're going to buy a stock, make sure it has a competitive advantage. 9. Failing to learn from mistakes. This is especially concerning when asset prices have been increasing for some time. A lot of investors wouldn't have experienced large losses, possibly making them complacent. In this situation, you can feel as though you are getting a hang of this investing thing and becoming an expert. Mistakes are part of the learning process. Don't be discouraged if things don't go as planned. Stay humble, always thinking that you're missing something and assume you're wrong. When things do inevitably go wrong, analyze what happened and use the lessons to make better decisions in the future. 10. Neglecting to monitor your investments. We can do so much research when buying an investment, but a lot of the time once we've invested, we can be guilty of not keeping up with the investment, and in some cases even simply forgetting about it. Businesses can change their management or the products or services they sell. Customer trends change or key customers can leave. Further, the economy can change and things like inflation can affect some businesses more than others. It's important to keep up to date with quarterly and annual reports and any investor updates so that you are informed and can react confidently to any price changes. Further, keep an eye on your portfolio and regularly review it to ensure it still aligns with your goals and risk tolerance. And there you have it, the top 10 beginner investing mistakes to avoid. Remember, knowledge is power. By being aware of these common pitfalls, you're one step closer to making smart investment decisions and growing your wealth. So go forth and invest wisely. Thanks for watching.